As a financial planner, we've had clients who have received inheritances from parents or loved ones, relatives. And in most cases, we've seen that folks who have received these dollars do have some type of an emotional attachment rather than just maybe money that they've earned on their own. So it's important to make sure that you're making the most of it and that you're getting what you want out of this inheritance. And also, in some ways, honoring the folks that have left this to you. But generally, where we like to start is just making sure that if you're receiving an inheritance, that you have an understanding of what the process looks like. And the first thing that we often like to do is just to make sure that if you're planning to receive one or you have received one, it could be unexpectedly, that you have a plan in place for what to do with the inheritance. I think it's understandable if you actually would like to take some of these funds and in some way honor the folks that have left this to you. So, for example, we sometimes see the case where parents leave money to children, and it was really important that the children be left debt free. So if there's outstanding debt, even though it might not be the most financially optimal thing that they can do in that time, maybe it's best that they look to pay off the mortgage. Another example would be when we help someone who was very into traveling and at their passing left money to their kids. The kids really wanted to make sure that they were able to go on a family trip together because it was a way that they could enjoy the funds that were left. And again, it's a way to honor the folks that left it to them. So again, while it's certainly understandable that there may not be strings attached or there couldn't be a certain plan with the inherited dollars, it's not a bad idea to make sure that you do have a plan in place. So if there are no strings attached and there's nothing that sentimental that you want to do with the funds, maybe it is looking to clean up some things financially that you can look to take advantage of. And that could include things like padding an emergency fund. Maybe it's contributing to retirement accounts that are lagging behind or paying off high interest debt, maybe funding children's education accounts. There could be a number of different things that could make sense. But regardless, as you're receiving these funds, it's a good idea to make sure that there's some level of a plan that you have to make sure that you can make the most of this inheritance. So while you may have an idea of what you're going to do when you get the funds, or if you're planning to get the funds, I think it's also a good idea to understand the process of how this works. And there are generally three different ways in which you can actually receive an inheritance. The first way would be that you could receive it through the estate, which generally will go through probate. You could receive funds via a trust, which wouldn't go through probate. And the third way is you could receive these passed on by beneficiary. Each of these have their own features to it and some pros and cons, but I think the biggest thing that you want to keep in mind is the timing of when you'll receive some of these funds. If the funds pass through the estate, it can take from 6 months to a year before those actual funds are able to reach the beneficiary. If assets pass through a trust, it could take a couple of months, but again, it could be a quicker process than if it were to go through probate. It could also be one that's a little bit more private if it were to pass through a trust. The other way it can pass is by beneficiary, and this can generally happen within a couple of weeks' time if done quickly and efficiently. But understanding the timing of when you'll actually receive these funds is going to be important because if you do have plans with the dollars, you want to make sure that your timing matches up with the time that you actually receive the funds. I do think another thing to really make sure that you have ironed out, though, is the taxation of these benefits. If you follow this channel, if you're familiar with us, Hyperion Financial, we focus a lot on tax planning. So if you are interested in tax planning and the way that it affects your retirement, I recommend you hit the subscribe button because we talk quite a bit on it. But when it comes to receiving an inheritance, there can be a number of different ways in which it could be taxed or a number of different ways in which it could be taxed down the road. Let's first start on the federal side. So when it comes to federal tax, there's no federal inheritance tax. In other words, a beneficiary wouldn't have to pay federal tax after he or she has received it when it comes to their inheritance itself. But there is a federal estate tax. Now, the exemption level is quite high at the moment. So, in the event that the person who passed away doesn't run into any estate tax issues, this shouldn't be a problem. However, keep in mind that at the end of 2025, as it currently stands, the Tax Cuts and Jobs Act of 2017, which raised that federal exemption amount so high, it is set to expire. Now, we'll be covering in a separate video the implications of the Tax Cuts and Jobs Act potentially expiring. But at the moment, I think it's fair to say that the federal exemption is likely to stay at the same level, potentially increase. But again, make sure that this is something that you're following because the timing of this could play a role. When it comes to assets that are received, there's typically three different ways in which funds can be received. They can either be received via traditional assets, Roth assets, or from non-qualified assets. If you receive funds in a traditional IRA or a pre-tax account, such as a pre-tax 401k, a pre-tax 403b, pre-tax 457 plan, however this is broken out, what ends up happening is there's what's known as the 10-year rule, in which case you would have 10 years to liquidate that account. So if any dollars have not been taxed to this point, and you receive these funds via a traditional IRA or traditional 401k, for example, you have 10 years to liquidate this account. And generally speaking, those distributions would be considered taxable. So having a tax plan in place if you're expecting to receive an inheritance can be an important thing to do. And again, it's good to plan ahead for this to make sure that you're not paying any more in tax that you should be otherwise. Now, with Roth assets, you're still subject to that 10-year liquidation timeline. However, if they are qualified withdrawals that you're making from a Roth IRA, you could receive these tax free. So you wouldn't have to worry about the same taxable implications that you would on their traditional accounts that you'd received, but you would be subject to the same 10-year rule. When it comes to non qualified assets, as the law is currently written, beneficiaries will generally receive what's called a step up in basis. So, in other words, if you would receive a stock that was held in a non qualified brokerage account and the cost basis was $10,000, but the value was worth $50,000, the person who passed that on to you at the time of death, that it would have been worth $50,000, would also be passing to you a step up in basis, in which case you would have $50,000 as your cost basis, not $10,000. But depending on your state of residence or the state of residence of the person who passed, there could either be state estate taxes or state inheritance taxes that you would be responsible for as well. What you're seeing here is a map of the 2024 estate and inheritance tax rules. So some states have both an estate and an inheritance tax. Some only have an inheritance tax, and others only have an estate tax. But as you'll be able to see in this chart, there could be some exceptions and exemptions that are held as well when it comes to state inheritance and state estate tax. Let's just take a quick look at a more complex one from an inheritance standpoint in Pennsylvania. In Pennsylvania, nearly all assets are going to be subject to the inheritance tax. But if a spouse passes away, the surviving spouse can generally receive these with no inheritance tax implications. However, if it's left to a child, for example, there's a 4.5% state inheritance tax that would be due. So you want to make sure if you receive these in a certain state like Pennsylvania that you address this. If you're leaving it to a sibling, that's at a different percentage. It could be taxed at 12%. Anyone else could be receiving a tax at 15%. So depending on how you receive these assets and who you're receiving them from, you want to make sure that your state rules apply as well. And speaking of taxes, my team and I at Hyperion Financial have created a quiz you can check out in the description below. It'll go through a couple different questions that you may be currently facing, some considerations that you might be facing. And if you fill it out and complete it and leave an email address, we'll film a quick video and actually just give you some high-level thoughts that could pertain to your situation. The link's in the description below. But lastly, and I think almost more importantly, would be I think this gives you an opportunity to address your retirement and your estate plan as well. For a lot of people, planning their estate is not always the funnest thing to think about. But when you go through the estate and inheritance process on the receiving end, it could jar some things that would cause you to want to take action and make sure that your own house is in order as well. Making sure that you have a plan in place for when you pass away could be something that could benefit your beneficiaries down the road. And again, while it may not be an imminent thing, it's never a bad idea to plan ahead because we never know when it's our time. If you found the video to be insightful, feel free to give it a like and put a question in the comment section if you have any. We've also done 2 videos recently that could pertain to your situation. The first one would be on the future of Social Security benefit tax. If you're interested in that, make sure you click right here. We've also covered a video on Roth conversions and the common mistakes that folks make. To check that video out, click right here.